Hi there folks, welcome to this week's weekly report, Monday the 10th of May. Boy, we had a busy week last week. For those of you trading the Forex market, you would have noticed that the US dollar was in a massive decline. Of course, what happened? Well, we had the US job numbers, the non-farm payroll out on Friday. Markets were expecting to see an extra million jobs created. But when the data was released at 8:30 New York time, it showed that just 266,000 jobs were created. And in fact, there was also a revision lower from the March data as well. So that really did shake up the market. 266,000 jobs created in a month. You'd think normally that was good. But the markets were expecting a much bigger read, and of course it disappointed. So the US dollar was in big decline. The euro against the US dollar, as you saw from my video last week, the most actively traded currency pair on the planet, that jumped about 120 pips, about 170 pips in 2 days. So the US dollar is in a steady decline at the moment as the rates are pushing lower. And the Fed have already mentioned the fact that they are not moving rates anytime soon. I think their dot plot is now out to 2023. That's when they're expecting the next move in interest rates. And also you may have heard of the term tapering. Tapering is basically the term that we use in terms of winding back on the asset purchasing. One way to control interest rates is to buy assets. So the Fed will buy their government bonds, basically putting more money into the system. If they're winding back on those asset purchasing, that in theory has an upward pressure on interest rates. And they basically had no mention of that anytime soon. The markets were expecting them to maybe start talking about tapering. It hasn't happened, so rates have been coming down, and that also has added fuel to the dollar weakness over the last couple of months or so. So this is the momentum meter. As you know, this is the tool that I use to basically tell me exactly what is going on in the currency markets. I think it's vital, if you're trading the currency markets, you are using something like this, because it basically tells me exactly where the money is going. Unfortunately, it doesn't tell me where the money is going in the future. It doesn't predict the future. No such tool out there does, but it tells me exactly what's going on at the moment. You can see here, down here, this green line, I've actually coloured it green. It's the US dollar. That has basically been in decline, and the most actively traded currency pair on the planet, as you now know, is the euro, and that has been trading up. So that basically now puts us on a 2-year high. We'll jump onto the charts in a minute and I'll show you exactly what else is going on there. What also you've seen here is a decline in the Japanese yen. That's the bronze line here, or the brown line there. That's the Japanese yen. I've got the color code there on the left. Japanese yen, basically, it's a funding currency. Now, normally when the markets are on risk on, that basically means when the markets are seeing a flood into equities, into the higher risk asset classes, you normally see the funding currencies. They're the low yielding currencies, like the Japanese yen. They get a downward pressure on those as well. And that's exactly what's happening. Global stock markets are on highs at the moment, and the funding currency, the Japanese yen, is basically paying for it. So the Japanese yen has basically been sold off, and buying anything against the Japanese yen is mostly making quite a good trend continuation trade at the moment. Not least of all is the Canadian dollar. Now, Canadian dollar has had a nice little up move over the last recent months or so. It's been one of the strongest currencies out there, although Canada had a really bad jobs read as well. But oil prices seem quite buoyant and seem to be supporting the CAD at the moment. Okay, so that's basically the momentum meter. You can get that if you come over to the forexsignals.com website. It's absolutely free to download. Right, okay, so what we're looking at this week, we're looking at a dollar short against the CAD. Remember, these are just biases. These are not trade signals. You can't go off and trade these now and make yourself a gazillionaire. These are just trade biases. You need to use your own strategy in order to take your trades or entries and exits. But we're looking at a continuation of the US dollar weakness this week and potential move still into the Canadian dollar, which is proving to be one of the resilient currencies out there despite those weak numbers. Now, when the dollar goes down, that generally means that the gold prices go up as well. Gold's been on a tail all the way up from about 1680 or so, now up there just above 1800 at the time of recording. We're looking at a target there at the previous high around the 1860 1870 level, spurred on by dollar weakness and risk on theme as well. So looking at gold higher, I'm looking at continuation of the CAD yen. You would have seen us last week, or my trade pick last week was buying the CAD and selling the yen, and that worked out really well last week. Made quite a few pips on that as we pulled back and get involved and getting back into it. My bias is continuation of that trend higher, CAD looking strong, yen looking weak. Buying anything really against the yen might make sense this week. But again, do your own analysis for your trade entries. And Max is looking at a euro short against the Australian dollar. Commodity prices looking quite well bid at the moment, which should support those commodity currencies like the Australian dollar, the New Zealand dollar, and indeed the CAD yen as well. So he's looking selling the euro against the Oz. The euro is at a crucial level against the US dollar. And indeed, if that holds, you could see the euro come lower this week as well. Let's just jump onto the charts now and have a look at exactly what is going on in the euro dollar and these markets. Come on. Okay, so first off, I want to take a look here at the US 10-year government bond yield. You remember, where bond yields go, the currency should follow. That's normally why we look at all these economic releases throughout the calendar month, to give us a clue where interest rates are going. You'll see this candle here. This was the non-farm payroll candle. When the markets came in with that big miss, bond yields collapsed down to 1.48. We have recovered somewhat since then. But if you look here, from just a short few days ago, we had bond yields back up there at around the 1.7, basically the end of April. So within the space of about 2 weeks, we've seen a big drop in yields, and that's been coupled with a drop in the US dollar as well. We're now at this all-important level, around the 1.6 level. So this is going to give us clues to where the US dollar is going to go in the coming days. Any price action below here, pushing back down maybe to the 1.5 level, we'll see continued weakness of the US dollar. So make sure you pay attention to what's happening to these yields. And those economic releases we see throughout the calendar week will give us clues onto where these yields may go as well. At the moment, yields are under pressure again this morning, off just maybe 0.5% today. That's why you're seeing some downward pressure on the US dollar as well, which I showed you there on the chart with the momentum meter showing the greenback considerably lower. Now, this is in fact the US dollar. Now, this is the dollar index. Okay, so it's the DXY. It's basically an index of 6 currencies against the US dollar, the top 6 currencies, of which the euro is the main component, accounts for 2/3 of the DXY. We've broken through key levels of support now. So the dollar has taken out this level that was supporting this market back from the 28th of April. And if you look back again from the beginning of March now, we are breaking out into new negative territory. The next level of support that we'll be looking for in the DXY comes in around the 89.70 level. So there's pretty much fresh air on the move back down into that next support zone. You may see some support coming in at around the 90 level, which is just shy of where we are at the moment. But the dollar is under pressure, and whilst the dollar stays below this level, the 90.50 level, the momentum push is likely to be, I would say, to the downside. But of course, you need to make sure you trade your strategies there as well. Okay, so if you head over to the forexsignals.com website and scroll right down to the bottom, you'll see our economic calendar. There it is, Forex economic calendar. I think it's really important that you are aware of what is going on if you're trading the markets. You've got your money on the line. You don't want to be caught with your pants down, so to speak. It's really important that you know what is coming out. And of course, there are also some potential money making opportunities as well. Now, the way you read this, of course, is by looking at the impact gauge here. Anything with red is high impact, means it's likely to have a big effect on the markets. Anything with green here, that's basically low impact news as well. You'll see here that you've got the previous read, you've got the estimate, and then of course, as the data is released, you get the actual as well. And if the actual differs massively from the estimated, that's normally when you expect to see a market move. You can look out here to see the next 7 days as well. Okay, normally, following on from non-farm payroll, normally it does have quite a light week in terms of economic releases, and this week is indeed quite light. We did have some GDP data out of the UK earlier today, showing a slight miss on the data reads there. Pound basically came under a little bit of pressure when that was released earlier. Not very much, as I say, coming out until midweek, when you've got the CPI data out of the US. CPI basically stands for Consumer Price Index. It's very important. It basically tells us what's happening to prices. And as you know, the central bankers around the world, they're mandated to keep a lid on prices, to keep control of prices, normally around 2%. So this is the actual read. You'll see Consumer Price Index year on year. The estimate is coming in at 3.6%. That's a big move from where they're supposed to be capping it at 2%. However, Fed Chair Powell has already mentioned on numerous occasions that they believe these price pressures to be transitory. Transitory basically meaning temporary, and that it will all settle down at some point. How long can you keep that theme going remains to be seen. But we'll be keeping an eye on the CPI data out of the US. As I say, not much else for the rest of the week, really pretty much until Friday, when we have the retail sales data out of the US as well. Retail sales basically is the early signs of what's happening to prices. There it is. Retail sales, export, import prices, and so forth. So we need to keep an eye on that. Of course, if everyone's spending money, retail sales are going up and what have you, that again has upward pressures on prices. So the central banker always likes to look at the retail sales data as well. So as I say, not much going out on the economic front this week. We've got a few central bank speakers as well, but keep an eye out for those as well. Central bank speakers giving us clues on where the economy may go in the future. We love a central bank speaker, don't we? Okay, so I hope you found that useful. You can come and join us in our daily live streams. We are streaming live around the clock, up to 6 times a day, 5 days a week, discussing market opportunities and so forth. You can come and join us, interact with us. You can take out a 7-day free trial. Just click the link below. If you don't want to stay, you don't have to pay. If that's not your thing, not a problem. I will see you next week. Have a good week.